This content reflects my personal observations and learning process while studying financial markets and digital assets. Any discussion of trading strategies or market structure relates only to my own trading framework and personal trading system. This material is for informational and documentation purposes only and should not be interpreted as financial advice or a recommendation to buy or sell any security or digital asset. Episode 18, Derivatives and Disciplined Trading. Over the past several episodes, I've been exploring how cryptocurrency markets operate. We've looked at market cycles, liquidity, institutional participation, and liquidation events. But there's another important layer in modern financial markets that can influence price movements. That layer is derivatives. A derivative is simply a financial contract whose value is based on another asset. In the cryptocurrency market, the underlying asset might be something like Bitcoin or Ethereum. The derivative itself is not the asset. It is a contract that allows traders to speculate on the future price of that asset. There are several common types of derivatives. In traditional markets, many investors are familiar with options and futures contracts. Cryptocurrency markets also have futures and options, but one of the most widely used instruments is something called perpetual futures. Perpetual futures are similar to traditional future contracts, but they do not have an expiration date. Traders can take positions that move with the price of the underlying asset, often using leverage to increase the size of their exposure. This leverage can amplify both gains and losses. Because of this, derivatives can influence the behavior of the market. When large numbers of traders are positioned in the same direction, using leverage, price movements can trigger liquidations. Those liquidations can create additional buying or selling pressure, which sometimes accelerates market moves. For someone observing the market, this helps explain why cryptocurrency prices can sometimes move quickly over short periods of time. But understanding derivatives does not mean a retail trader needs to use them. For my own approach, the goal is not to chase every new financial instrument. Instead, it is to understand the structure of the market and operate within a disciplined system. A disciplined trading system focuses on capital management, risk control, and patience. Rather than relying on leverage, the system prioritizes survivability and long-term consistency. Understanding derivatives simply helps provide context. It allows traders to recognize that markets include many different participants, institutions, leveraged traders, and retail investors, all interacting within the same environment. By understanding how these forces operate, we can approach the market with clear expectations and avoid reacting emotionally to short-term volatility. And as with every episode in this learning series, the purpose is not speculation. It is learning how the system works. Because before capital moves, understanding should always come first.